Most people fear market crashes. When they see red charts, scary headlines, and falling prices, they panic. They sell everything. They freeze, or they run away from investing entirely. But rich people, they see the same chaos, and they smile. Because for them, market crashes aren't a disaster. They're an opportunity. The wealthiest investors in the world understand something most people don't. Money is made when the market is down, not when it's up. Fortunes are built during fear and realized during recovery. Whether it's the dot-com crash, the 2008 financial crisis, the 2020 pandemic crash, or any future recession, rich people follow the same principles to grow their wealth while everyone else loses money. Today, I'll break down exactly how rich people make money in market crashes, step by step, so you can learn to think like they do and stop being afraid of downturns. 1. Liquidity. Cash saved for moments of maximum fear. Rich people keep cash on the sidelines on purpose. Not because they're scared, but because they're waiting. They know that every few years, the market will crash. And when it does, everything goes on sale. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." During the 2008 crisis, Buffett had billions ready, and he bought quality companies at massive discounts. During the 2020 pandemic crash, wealthy investors scooped up tech stocks at 30 to 40% off. While the average investor is panicking, the rich are preparing. Let me ask you, if markets dropped 40% tomorrow, would you panic or would you buy? Comment below. Fear or opportunity? I want to see how you think. 2. They're not emotional investors. The rich don't view market crashes as disasters. They view them as normal. Part of the game? Expected. They follow data, not emotions. They know the stock market has never failed to recover in modern history. They know drawdowns are temporary, but wealth is built long-term. While regular people say, "Oh no, everything is going down," the rich say, "Perfect. It's finally cheap again." This alone puts them mentally ahead of 99% of investors. 3. Access and relationships. Wealthy people have something the average investor doesn't: access. During crashes, they get access to private deals, distressed real estate, exclusive fund opportunities, conversations with top analysts, direct lines to private bankers, inside insights from CEOs and fund managers. Not illegal insider information, but proximity. When you can talk to the people who move the markets, you understand the game better. That access gives rich investors confidence, and confidence leads to bold moves. 4. Value investing on steroids. This is where the rich really make money. In a crash, stock prices fall much faster than the quality of the businesses, so wealthy investors buy. Blue chip stocks, high cash flow companies, dominant brands, companies with strong balance sheets. Imagine buying Microsoft, Amazon, Google, or Apple at 30% off. That's exactly what happens in crashes. The rich aren't guessing. They're buying proven companies at discount prices, and then they hold. When the recovery comes, their portfolios explode in value. If this is helping you think differently about money, hit subscribe right now. I make videos that show you how to think like the wealthy instead of guessing like everyone else. 5. Short selling and hedging, the protect and profit move. The rich don't just buy during crashes. Sometimes they profit from the crash itself. Hedge funds, sophisticated traders, and wealthy investors use put options, hedging strategies, short positions. Inverse ETFs, they protect their portfolios when things fall, and sometimes even make money while markets decline. It's not gambling, it's insurance, and that protection gives them more confidence to stay invested. 6. They invest through funds. Wealthy people rarely invest alone. They use hedge funds, private equity funds, venture funds, distressed asset funds during market crashes. These funds become extremely active, buying assets ordinary investors never even see. When recovery hits, the profits are enormous and shared with the investors inside those funds. 7. They use leverage strategically. During a crash, wealthy investors sometimes borrow money cheaply to to buy valuable assets at a discount. This could be margin loans, credit lines, real estate loans. It's risky if done wrong, but the rich do it with safety margins and low interest. It's how they turn a 30% market drop into a 100% or 200% gain on recovery. They're not gambling, they're amplifying opportunity. 8. They have tax advantages that multiply their gains. Even when markets crash, wealthy investors use tax strategies to protect and grow their money. They use tax loss, harvesting, long-term capital gains, borrowing instead of selling, depreciation on real estate, owning assets inside trusts and corporations. These strategies allow them to recover faster and keep more profit than the average investor. Taxes don't stop the rich, they work around them strategically. Market crashes aren't the end, they're the beginning. They're the moments when real wealth is transferred from the emotional to the strategic, from the panicked to the prepared, from the uninformed to the educated. Rich people don't fear market crashes. They prepare, they plan, and they profit. If you got value from today's video, hit like, drop a comment, and make sure to subscribe for more insights on how to build real wealth, not just save money. Thanks for watching, and I'll see you in the next one.